Hello everybody, and welcome to My Finance Teacher. I hope everybody is having a nice day. Today is 20th of March 2018, and we're looking at gold. Very interesting news coming up in gold tomorrow, of course, on Wednesday. It's the FOMC meeting, and we're going to talk about that in a minute. First, I want to look at the US dollar because, of course, that also has some influence on the price of gold. So the US dollar has recently, well, not that recently, about a month ago, completed this intermediate cycle that has been going on since September until mid of February or something like that. And we are now, the US dollar is now in this upward channel. However, it's spending a little bit too much time near the bottom range of that channel, and it's having trouble breaking above this 50-day moving average. So what needs to happen with the US dollar is it needs to push above the 50-day moving average with some force and move back up into the middle and higher range of this channel. Otherwise, the US dollar is in danger of breaking down after a rally of only about a month. So tomorrow, with the Fed rate most likely taking place, that might help the US dollar finally breaking above and closing above the 50-day moving average. We'll have a look at that. The Fed rate hike is very likely. The futures market gives it a 93% chance. Well, in that light, let's have a look at how the recent several Fed rate hikes influenced the gold price. So this is the history of when these Fed rate hikes took place. So here's the gold price. We're going to talk about the channel and going all the way back to December 2015. Right. So that Fed rate hike was on the 16th, right here. Right here. Okay, right here. So generally, in expectation of a Fed rate hike, of course, gold moves down. After the Fed rate hike takes place, what happens is sort of a sell the rumor, buy the fact behavior. After the rate takes place, there is not much reason for gold to experience downward pressure, and it sort of either languishes at the level where it is or tends to move upwards. That's what happened in December 2015. Next was 14th of December 2016. Let's have a look at what happened to gold then. So that's 14th of December. So basically the same thing. In expectation of the rate hike, gold moves down. Of course, there are other factors as well. And after the rate hike, this downward pressure is relieved, and gold either continues a little bit down or languishes where it was, as it happened in the December of 2015. But basically, after a while, it ends up higher than on the day of the rate hike, and often considerably higher. Another one was in 15th of March, on the 15th of March. Right, March 15th. There you go. There you go again. The same thing happening. Expectation of rate hike and gold moving higher. 14th of June. June 14th. Right. Sort of a similar thing happened. Yes, gold went down for several days prior to that, but it continued moving down. But of course, one other factor that was forcing the gold down is simply the market sentiment. The cycle, the intermediate cycle, was in its declining phase. So the cycle had to finish before gold could start a relatively strong rally. But nevertheless, this is the mid of June. and this is second half of July. After just over a month, gold came back to where it was on the day of the rate hike, and after another month it was considerably higher. And lastly, 13th of December 2017, right, here you go again, same thing happening, expectation of a rate hike and gold moving higher. Well, on Wednesday we'll see a rate hike, and what is going to happen to gold is very interesting. If history repeats, then we might see gold prices moving upwards relatively soon. But in the shorter term, I expect gold to continue down for a while, especially tomorrow with the rate hike. So gold moving down, well, how low down? Here. This is a 200-day moving average. I think that could be a relatively good support level for gold. That, as well as sort of this range. So I expect that the area between sort of 1290 and 1300 will be a support zone for gold. I expect in the very short term gold to continue declining somewhere into that area, and after that I expect a rally from gold. A rally, although this intermediate cycle has not been really going on for that long. Generally they last for about half a year, and if we say that we're going to finish this intermediate cycle relatively soon, say near the end of March, that would only give us 3.5 months, somewhere between 3 and 3.5 months. Is that too short for an intermediate cycle? It might be too short. So this rally that I expect from gold might either be a continuation of this intermediate cycle, in which case we're going to see lower prices relatively soon, or it might be an advancing phase of a new intermediate cycle. Well, given that this cycle has only been going on for about 3 months, I think I would give it a 60% chance that this rally is not going to be an advancing phase of an intermediate cycle. It might be an advancing phase of, let's say, a daily cycle, which will turn down. They generally last for a couple of months or so. So that will take us somewhere into mid-May or the second half of May. And that could be a lower low for gold, especially given the history that summer is usually a very dull period for gold, with gold prices sliding down. In any case, I think we'll have a look at that once we cross the bridge tomorrow and see what happens with the Fed rate hike and how the dollar as well as the gold reacts to that. But there is still some chance, I think, of a rally, at least a short-term rally, relatively soon. What is the potential of that rally? Well, if, let's say, gold moves from 1290 to, well, how high this rally will go? Let's say this arrow's height, that's 1330. That will give us a 3.1% gain in gold itself from 1290 to 1330. And looking at GDX, I think the potential is relatively better here because gold miners have been suppressed quite a lot. If you compare gold to its 200-day moving average, for example, gold is currently higher than its 200-day moving average, whereas gold miners are lower than their 200-day moving average. This is GDX. So I think a potential for sort of a nice pop-up is better in GDX, given that it has been suppressed so much over the last couple of months. Well, let's say GDX goes down. Let's say GDX goes down to tomorrow with the Fed rate hike and over the next several days. Okay, let's say 21, down to 21. And after that, let's say it goes up to, well, let's say just only retrieves the 200-day moving average. So that will give us something like 22.8. A rally from 21 to 22.8 is 8.5% gain. So to be honest, I think I might be buying GDX somewhere around 21 or just below that. Remember, this is not investment advice, and you need to do your own analysis as well as employ your own judgment. But I do wish you luck in your trades, and thank you for your attention.